Welcome to another special edition of your weekly market update. Chad is taking a well-deserved spring break vacation with the lovely Lubin ladies. Not to worry, he will be back first thing Monday. But we wanted to be sure that you caught wind of the two important news items regarding inflation this week, as well as how they're going to impact mortgage rates moving forward. So let's go ahead and dive into the Consumer Price Index report for the month of February that we received yesterday. So as you can see here, month over month headline CPI is up 0.44%, and that has brought the year over year change up from 3.1% to 3.2%. Core CPI is up 0.36%, and that has brought the year over year change down actually from 3.9% to 3.8%. I can hear you asking now, Ryan, how does a higher month over month number lead to a lower year over year number? Well, keep in mind, these are 12-month averages. So if we go and take a look here at the chart from the Bureau of Labor Statistics for CPI over the past few years, we can see here at the blue dotted line, which is core CPI, that February 2023 was actually a much higher number, just over 6%. So when we consider this much lower number coming in, replacing this much higher number, that brings the average down and results in a lower year over year change. So let's go take a look back here at this breakdown and let's discuss core CPI a little bit more. As you can see, 5 items specifically contribute to just over half of core CPI. Shelter being the main component here, which is up 0.4% month over month. Rent is up 0.5% month over month, and we believe this is a little suspect, so to speak. We believe this is a little bit high considering the much lower data that we've seen from CoreLogic being reported in the same data field. So worth considering there. Another thing worth considering here of the core CPI is education and communication, as well as motor vehicle insurance. These two industries aren't as impacted by interest rates as, of course, shelter is, rents, mortgages, things of that nature. So worth noting that keeping interest rates higher might not necessarily contain these components of inflation as the Fed might reasonably expect. So let's hope that they are looking at the data in the much same way that we are looking at the data. So that is worth noting. The second item of news coming out this week is the Producer Price Index report, and that is largely considered as wholesale inflation. That is coming out tomorrow, and we do expect the headline number to be higher than anticipated and actually higher than what most analysts are predicting. So that is important because we're also seeing technical data in the trading charts that suggest a possible change in rates here. So let's take a look at that. First, we're going to take a look at the 10-year Treasury, which, remember, trades in direct competition with mortgage-backed securities. Again, mortgage-backed securities are what determines your interest rates on your loan, not the banks, not the Federal Reserve. So let's look at the 10-year Treasury here, which competes with mortgage-backed securities. As you can see, we've been on a bit of a run up with the Treasury. We're actually testing a ceiling of resistance, which is the 200-day moving average. And this is very important because if we push above this, then we're going to see some direct and negative results on mortgage-backed security trading. So let's take a look at that. As you can see here, we are testing a floor of support in the form of the 50-day moving average. And if you look closely here, you can see there's a little ways to go if we break past this floor of support, all the way down to the 25-day moving average. So for context here, that's roughly 0.4% there. That's quite a bit. So we need to be careful and watch that. If we do see Producer Price Index report come out much higher than anticipated and along the lines of our predictions, higher than most analysts, then we need to be careful and watch the technical data as well and potentially lock in any mortgages that we've got floating right now to avoid lower rate or higher rates in the future, excuse me. So that's why it's important to work with a professional, someone that's been following these markets for, gosh, it would be 30 plus years combined now for Chad and Derek. So if you have any questions regarding your home search, give us a call at 312-731-4939. That's 312-731-4939. Or you can email us at chad@thelubingroup.com. That's chad@thelubingroup.com.